Thanks for being with us. Ed, I am going to start with you. The fact that we do have a little more insight from these minutes, but really speaks to this tightening cycle at the Fed and a cycle that is poised to be much faster and more aggressive than we have seen in cycles past right now. The rotation from growth into value, does that continue here? And if so, what does that mean in terms of the action that we're going to see over coming weeks and coming months in the major averages?
Sure. Morgan, I think much is going to depend on how long this taper tantrum lasts. This is the fourth taper tantrum that we've had since 2013. We had one in May 2013. We had one in early 2016, and then there was one in 2018. The big difference between this fourth one and the previous three is in this fourth one, there really is a problem, and there's an inflation problem. Back in the previous three, when the stock market had a taper tantrum, the Fed could respond to that and say, okay, we're going to ease off. We're not seriously going to be tightening as much as we suggested. And that worked out as a buying opportunity. This time around, everybody, as Steve said, is dependent on an unknown, which is when inflation might moderate and the extent to which the Fed's tapering might actually do that. I'm seeing some evidence that the supply chain disruptions are starting to ease a bit. I'm seeing that in the Fed's 5 surveys of regional businesses. Delivery times are starting to come down a bit. I saw that in the ISM Purchasing Managers Index, the prices paid for manufacturing. I didn't see that in the services number this morning. The prices paid is still high. But I think we're going to find that inflation tends to moderate after maybe a month or two of moving a bit higher. But I think that's really the key. If it turns out that the Fed just pivoted to an excessive amount, that the market reacted in an excessive way to this minutes, then I think we shouldn't get too excited about the sell-off.
Okay. So, Aaron, you cover internet stocks. Do you see buying opportunities now, or do the names that you do cover have further to fall?
Yeah, no, our names have been down quite a bit, obviously, the last couple of months here, with the sector down about 20-30% for a lot of the names over the last 3 months. And if you look at the kind of the 5-year EV to sales averages, you're about 10% below in the large caps, about 20% below on the averages for a lot of the small cap names in the space. If you look at some of the large caps right now, you have Google and Facebook both trading around 23 times their calendar 22 earnings per share numbers for companies still growing at a high teens rate. So you actually see Google and Facebook shares are up today. We think those are relative value in this market. Still could see some names pull back. We think for a lot of the names in our sector, you've seen those pullbacks already. Alibaba trading sub 10 times earnings based on our sum of the parts. Then you have some small cap names, which we would be buyers of here. We think ZipRecruiter is nice. It plays into the large job openings numbers. The RealReal, which have had good numbers put up yesterday, we think will put up some good numbers and show some increasing leverage in the year as well. So there are some selective names on the small cap side we would be buyers of, and we continue to like Google, Facebook, Amazon, and Alibaba as well. And we think valuations are attractive on this recent pullback.